go through Platinum, keep that in mind, where they will do the full approval for the buyer during the time that we're negotiating the short sale. It's not just a pre-approval, because we all know that buyers say, well, I want to wait and see if the short sale gets approved before I go and spend the money on the appraisal, which makes sense. But what Walker Jackson will do, and correct me if I'm wrong, Dan, is you'll do the full approval including the appraisal, correct?
Yeah, we'll do that for your group, yeah.
Okay.
That's no trouble.
So expand on the program a little bit for me, because I don't want to mess this up.
Well, I mean, it's not tremendously different than how we would handle some other short sales. We don't have the trouble. You mentioned that the lender will come back and say, contract approved, let's close in 2 weeks, 3 weeks. We close in 3 weeks on average, so we have the ability to hustle and get things going. And we've been accumulating documents to get that client approved while it's in the approval process. But because of the delicate nature here, we've reached an agreement and said we'll just package it like any other loan, assume that it's an approved deal, submit it up, our normal 48 hours, we'll have a full commitment, we'll order the appraisal, have that in as a supporting document. That may help in the negotiations.
Absolutely.
In some way, shape, or form. And so we felt like that was a nice proactive touch to add to this feature. And then, on the occasion that the deal falls apart at no fault of the buyer, I think is what we said. So if the buyer can't pull out or say forget it, then if we can retain that buyer, we will credit them for their next appraisal on a new property if they do that. That way we can keep them kind of control. We've already gone through the trouble of gathering documentation. It's very smooth and seamless to get their next one done. We'll take care of their next appraisal. We do, for cost reasons, have to kind of limit it to that. So if it goes to a third one, unfortunately, I can't pay for a third appraisal for them. But that way you get a fast approval. It helps in the negotiation, and they're not worried about the upfront fee, if it falls apart.
And we just talked about keeping the buyer engaged. A buyer is engaged when they have a full-blown approval versus a pre-approval. And we've seen it happen where they truly stay engaged because they have the appraisal done, this is the house that they're buying. And like Dan said, if it falls apart because, let's say, the seller doesn't like the terms of the approval, whatever the case may be, as long as it's not the buyer walking, okay? That all adds into setting realistic expectations with the buyer. And as Dan said, when we go to challenge a BPO, rather than go back to the agent and say, can you pull more comps for me? To have that appraisal in hand to go back to the lender is huge, huge. And you don't have that luxury in normal short sales because the buyer has not gone for their financing yet. So it's a fantastic program. I encourage all of you in here to talk to the buyer's agents about it, because the buyers may have a pre-approval in hand with another lender, but let me tell you, if you talk to that buyer's agent about this program, you will keep that buyer engaged. So thank you, Dan. I also wanted to tell you that in the back is another form, and it's called Buyer's Acknowledgement of Short Sale Expectations. And it basically is a form that you can hand to the buyer's agent and just say, look, here's realistic expectations. Now on here it does have buyer signatures. You don't have to get the buyer to sign. That's completely up to you. This is not a required form for us. This is a helpful form for you, if you're the listing agent, to hand to the buyer's agent to give to their buyers, okay? So let's move on. Let's talk about working with the lenders and what you can expect. Like I had said, here's the departments that the lenders have. So they have the short sale department, they have their modification department, they have their foreclosure department, their borrower outreach department, and the vendors. None of them speak to each other, ever, okay? It's a very delicate process, so we hear all the time from the sellers, how did you not know that I was in a modification? Because you can't do a mod and a short sale at the same time, the banks won't let you. So I'm like, I had no way of knowing because I work with the short sale department. The only thing the short sale department will tell me is if there's a foreclosure. They will not tell me if a mod's in place or anything else. So keep that in mind. It's a complicated process. If you or the seller finds out about mods, foreclosures, whatever, don't get upset with us, just let us know. So the short sale package, here's what the lender's looking for. Like I said, we're going to collect all the docs. The list of docs can be found on our website. We'll get the HUD one. We'll compare it to the contract for accuracy because they have to match, okay? We'll then review the contract for acceptable terms. Like I said, 60 days for third-party approval and 1 to 3% in seller concessions. Okay. We will then submit the package to the lender, and then you'll get your user ID and password to the portal. Here's what you can expect. From the seller, expect this, that we're going to ask for documentation a lot because the lenders ask for that. When you submit a package to the lender, the documentation should all be within 30 days. Because if the lender takes on average of 60 days, that means your documentation is a total of 90 days. Once a doc is over 90 days old, the bank will pick it out. It doesn't matter if a bank takes 60 days to review the docs. They don't care. Those docs have to be dated within 30 to 90 days, depending on the lender. So we will, over the course of negotiation, be asking the seller for docs to update docs numerous times, okay? The seller can also pretty much anticipate the lender's gonna reach out directly to them despite our efforts with the lender. And we tell the seller, when you get a call from the lender, answer the call and just say, you know what, talk to my agent, you can talk to Platinum Group Services, that's who's working on my short sale. And let us know that the bank reached out to the seller. We always tell the seller, let us know immediately if you get a call, we'll take care of it. A lot of the sellers don't even want to talk to the lender, and that's fine. They don't even want to answer the call. They can pick up the phone, call us and say, I just got a call from Chase, we'll call Chase. But they can expect that the lender will contact them despite the fact that we're negotiating the short sale contract. As a buyer, what they can expect is that they may need to provide personal information too to the lender. So the banks that work on Equator, which is Bank of America, GMAC, and soon to be Wells. Have anybody done a Wells transaction on Equator yet? It's coming. They do have to provide personal information, like the last 4 digits of their social security number and their date of birth. A lot of buyers get upset by this. It's simply to prevent fraud, straw buyers, okay? And as the agent, please know as well that the lender may reach out to you directly. And again, we just ask that you pick up the phone and call us. So the communication with the lender begins after the package is submitted. The lenders will reach out to you directly, as I said. Please let us know if that occurs. But like I said, only one third party should be submitted. When we get agents that submit their own third party, and we have a third party in there, it really can jeopardize the flow of communication that comes from the lender. And it's so rare that you get a good flow of communication from the lenders that please don't do anything to jeopardize that. And then obviously we'll update the portal a minimum of once per week. When we're in the throes of negotiations, you'll see a lot of notes in the very beginning when we're just submitting the package and making sure they have the package, or the BPO has been ordered but not received. There's not much to do on our end. We'll kind of go over the entire process that the lender goes through. So everybody always asks us about working with the lenders. Well, what are the time frames? You know, so much of it depends on, is there 1 lien, is there 2 liens, is it conventional, is it FHA, who is the lender? So I'm going to tell you the good, the bad, and the ugly. The good is Wells Fargo, Citi, and GMAC, and conventional loans in general. Okay, they're pretty good with their turnaround time frames. And by the way, if you say 60 days for third-party approval, you're probably going to get it less from those 3 lenders. The bad is Bank of America, Chase, and all FHA loans. FHA has a lengthier process. They manually underwrite the files for a short sale versus go through any kind of, conventional system. And the ugly is SunTrust. Now, is SunTrust prevalent down here? It is, okay. They're really, how many of you work with SunTrust? Do you find them difficult?
I'm not on short sales, I find them great on loans.
Yeah.
But I haven't worked with them on short sales.
Okay. So I was talking specifically about short sales. They take on average about 6 months. They're really, really difficult to work with on short sales. But we do it and we get them approved. It just takes us a long time. Obviously 2 liens will take longer to negotiate than 1 lien. Segmentation, who knows about segmentation? Okay, well this is part of Equator's new system. It's called segmentation. So it's a waterfall test. And all banks are doing it. Some are doing it on Equator, some are doing it manually. Where they take a file in, this is why I don't talk about HAFA anymore in my presentations. Everybody knows what HAFA is, and you don't even have to know what it is because the banks test all files for HAFA now. So it's a waterfall test. When the file comes in, they first test it and say, does it fit into the HAFA box? If it doesn't fit into the HAFA box, they say, does it fit into the cooperative short sale box? And just as a reminder, a cooperative short sale is the bank's modified version of HAFA. If it doesn't fit into cooperative short sale box, does it fit into a traditional short sale box or classic? So it's got to go through that segmentation. On Equator now, guess how long segmentation takes? 30 days. It takes 30 days for them to figure out what box it fits in, then they start the short sale process. So this whole thing about Equator is going to make life better. Right now it's making it a whole lot worse with any lender that uses Equator. But I will tell you this, like I said, Kim and I were in Plano, Texas and met with Bank of America and met with the Equator people. I have confidence that it truly is going to make the process better. It's just that they rolled it out April 7th. They ran into a lot of technology problems. They have not overcome the problems yet. When they do, it will be better, but right now, just know this, we are all living in equator hell. Whether you know it or not, we really are, and hopefully it'll get better soon. So if it's going through segmentation, it adds 30 days to the process. We talked about equator. If there are vendors involved, that can affect the time frame because some vendors are better than others. Now, the bank that uses vendors the most is Bank of America because they have the most short sales. And we actually met with Dave Sunland, who's the vice president at Bank of America. He's head of all short sales. We met with him when we were down in Florida. And you know, a lot of agents were in the room as well, and they were complaining about certain vendors. And he did say, he said, listen, he goes, we know the lenders that are bad, we know the lenders that are good, and we're working on getting rid of the bad ones. But in the meantime, the bad ones still have thousands of loans. So depending on what vendor you get, depends on the time frame as well. And like I said, I can't control the lender's time frame. I can control how many times I pick up the phone and call the lender, but I can't control their time frame. So their process is from soup to nuts. First thing they do is they get the package and they check and make sure it's complete, and then it's updated. Because if it's not complete, they'll kick it back to you. If it's not updated, it doesn't move to the next stage. Then it goes through segmentation, which is the waterfall test. Then they order a BPO. Then they receive their BPO, okay? Once they get the BPO in, they do a soft credit pull and they order the payoff. Keep in mind, they're gonna look at the seller's credit. So if your seller is paying everything other than the mortgage, that is going to be a problem. Like our Dr. Park, who had 3 BMW loans that he paid on time but couldn't pay his mortgage. That was quite a challenge with Chase. But we got that through. He had to pay some money then, but we got it through. Once they have all that documentation, they've got the credit report, they've got the payoff, they've got the BPO, then they assign it to a negotiator. This is where communication really kicks in between the bank and us. Then it will go to second level review if necessary. Second level review occurs if there's PMI on the loan, the PMI companies want to review it themselves, if the investor wants to review it themselves, or if the amount of loss is at a certain level. So I'll give you an example. At Bank of America, if the loss is over $400,000, they lose all delegation. They can't look at it. It's got to go directly to the investor. And every bank has a different threshold for what goes to second level review. But second level review occurs on actually many of the files, which takes a little bit longer. Then the decision is levied, and then we go to closing. So that is the process from start to finish. So I want to talk about the BPO, which is the broker price opinion. They're good for 90 days. They're very difficult to appeal, although we try, but you can't simply, you know, agents will say, well, you got to call the bank and tell them that they're crazy. Okay, that type of appeal doesn't work. We have to get additional comps from you, or like Dan talked about, get the appraisal and go back and fight it. But I will tell you this, a lot of banks don't move off their BPO prices. The lender's net requirement is generally 85 to 90% of the BPO, depending on who the investor is. And your best defense to get a realistic BPO is meet the agent at the property. So you're the one who's going to get a call, say, I'm coming out to do the BPO. Meet the agent at the property, because I will tell you this, and we do a lot in Maryland. We had a Maryland agent say to us that he went out to the property, and the agent that was there to do the BPO was from Virginia, 80 miles away. He's like, how could this guy possibly come up with a realistic value? But he was there, he talked to the agent, he said, hey, I have comps, do you need help with this? I have interior photos, I have everything you can possibly want on this house. So meet the agent there, and when you do the CMA, because your CMA is going to be submitted to the bank, make sure it is detailed. If there's something wrong with the property, give me a little narrative, give me pictures if you want to, but give me a detailed CMA to submit to the bank. Those are your two best defenses against the BPO. So I will tell you, there are 6 lenders that we will not work with, and that is Aquin, Acacia, Bogman, Sovereign, Navy Federal Credit Union, and First Horizon. Does that impact you greatly in this room?
We use a lot of options because DR Court is sold out to
Good luck.
First Horizon. I haven't had any trouble with Aquin here.
We've had nothing but. They've been very, very difficult to work with. And I will tell you, Acacia just won't do them. That's why we don't work with Acacia. Navy Federal Credit Union, they're really great. They say, oh no, we'll release the property, but the seller's on the hook for the rest. So they don't agree to actually short sell. They just say, well, we'll release it, but if you signed a $400,000 note, you still owe me all $400,000. We haven't had a seller yet to agree to that. But we don't work with them basically due to customer service reasons, okay? When it takes us 6 to 9 to 12 months to get a response, and when we have to call every day for 4 weeks to get a return call, that's a bad reflection on us. We're just not gonna do it. We don't want that reflection on customer service, So those are the lenders that we will not work with. So let's talk about lender decisions. Okay, approvals. We get a lot of approvals. 95% of the files that we submit, 96% actually, do get approved because we know what we're doing. We're not going to submit the ones that we know won't get approved. But there is an expiration date, and it's based on either the level of delinquency or the date of the BPO, and we talked about that. We talked about the Walker-Jackson program, have your buyers ready to settle. The language cannot be changed. The sellers have to sign the approval, and we get it back all the time where they're crossing out lines on the approval. Okay, I can't submit that. You cannot change the language in the approval. The seller may be released from all liability, which is fantastic. That's the best possible outcome. They may need to choose between a deficiency judgment or a contribution or a promissory note. We'll talk about that. Second lien approvals tend to have deficiency language where they say, look, I reserve the right to go after the seller. And why is that? Because the second lien holders lose their shirt. They get on average $3,000 to $6,000. Okay, so typically they will reserve the right to pursue a deficiency judgment against the seller. And the second lien approvals can release the note sometimes, but not the seller's obligation. That's rare, but we're starting to see it happen more and more. I will tell you, two second lien holders that are really tough for us, but we do work with them, are PNC and Green Tree. Are they prevalent down here? So PNC and Green Tree as second lien holders require between 10 and 30% of their balance. And they were like jumbo second lien holders. So we'd get these Green Tree second liens in, and like the balance is, you know, $150,000. And they say, the good news is we only want $45,000. I'm like, oh my God. Well, the good news is you'll get 3. And then we start at that point. So they're tough to deal with, but we do work with them. We are successful with them, but they're tough sometimes. So let's talk about the deficiency language that you can see in approvals. It's basically the lender reserving the right to pursue a deficiency against the seller at a later date. In order to do that, the lender would first have to go to court and get an actual judgment, and then they would pursue that judgment against the seller. This is all after the short sale approves. But what lenders like to do, the real reason they're putting that language in, is they're going to bundle them up and they're going to sell them off to a collection agency. Because these lenders, once they're done with the short sales, they really don't go after the sellers too much. They sell it to a collection company for pennies on the dollar, and that collections company goes after the seller. Now, I will tell you that Wells Fargo is pretty good. They have a recovery department. So if they have deficiency language in approval, your seller's probably going to get a call from Wells within 60 days saying, okay, I want some money. What the seller chooses to do at that point in time is up to them, but Wells does make the effort to get the money. A lot of the banks will never make the effort, and Bank of America actually told us it depends on the amount of the loss. If we've lost 100 grand, we're probably going after the seller. If we've lost 10 or 20, we could care less. It's not worth our while to even go to court to get the judgment. They're just reserving the right. So promissory note. If a seller has PMI, I can guarantee you that they're going to get a promissory note from the PMI company. I can guarantee it. Although what we're hearing, scuttlebutt on the street, is that the PMI companies are starting to move away from promissory notes and they want seller contributions because they know that the seller's going to sign a promissory note and never pay them. So they'd rather get $2,000 or $3,000 from the seller at closing than a promissory note. But right now, we do see the promissory notes from the PMI companies. The terms are always favorable. It's generally 0% interest, and it's just for a portion of the loss. It's not for the full amount. Very standard with the PMI companies. It's an unsecured note, and if unpaid again, those promissory notes get sold off to a collection company. But everybody's getting wise to the fact that the seller signed a secured note a few years back and didn't pay, so they're probably not going to pay an unsecured note. They're all getting very wise to that. Seller contribution is becoming much more popular with the lenders. Like I said, they'd rather take $2,000, $3,000, $4,000, $5,000 from the seller closing and say goodbye, no deficiency language or anything, than take the chance and the cost of going to court and getting a judgment and then having the seller declare bankruptcy and saying your judgment means nothing to me. So they're wising up to the fact, and we are seeing more seller contribution requirements. What Bank of America does is they have this nice little letter where they give the seller a choice. You can either pay me $5,000, or you can accept a promissory note, or we can levy a deficiency against you. So they actually give the seller the choice on their second liens. But again, it's a minimal contribution. It might be, the highest we've ever seen is $10,000. It's generally $2,000 to $5,000 that they'll ask for. And that is in lieu of a larger promissory note or deficiency language. And it's also based on the credit report review that they do. So if they feel that the seller is making payments to other lien holders and to car companies and credit card companies, they will ask for seller contribution because they're like, wait a minute, that seller's paying everybody but me, so I want some money from the seller at closing. And they also look and see if the seller has assets. If the seller does have assets, they will ask for a contribution. So allowable and non-allowable fees on the HUD, all right? Title fees tend to get chopped. Typical ones are doc prep, file archive, and release fees that we see get cut. Banks tend to, reduce those fees quite a bit. Administrative real estate fees, other than a commission, tend to get cut. So we work with a real estate company up north, and they charge a $355 administrative fee to the agent. So the agent puts it on the HUD. The lenders don't pay it. They pay commissions, but not administrative fees typically. Back taxes tend to always get paid, but homeowners is like a 50-50 shot, basically. And caps can be placed on water and sewer and ground rent fees. It's all based on investor guidelines. So homeowners and other back fees other than taxes, there's generally a cap that the bank will pay. Keep in mind your best, yes?
You mentioned assets, is there a cap on what they go after?
There's not really a cap. It's based on what the seller has. The most I've ever seen, like I said, was the guy had, I'll never forget it, Mr. Nielsen, he had $400,000 to $500,000 in 401k, and Wells Fargo wanted $40,000 to $50,000, so they wanted 10%. But I will tell you that by and large, truly, our sellers don't have assets. I mean, they truly are distressed. So there's no set formula. Commissions. 6% is guaranteed only if it's a half a file. And by the way, only 9% of files qualify for half a. So a lot of the agents say, well, it's the law. Obama passed a law, I'm going to get 6%. There is no law. It's something called HAFA that is voluntary for the servicers, and only 9% of files, work through HAFA. But we, like I said, we average 5.75%, and we're doing much better with getting the full 6% because we feel that the lenders are getting better. On the cooperative short sales that the lenders are doing, that's their version of HAFA. They're saying that they'll pay 6% under certain circumstances if their net is met. So we're seeing 6% much more popular now. But your commission can be affected by the lender's net, which is why you don't want to accept low offers and you don't want excessive fees. So if you're putting down that the seller's getting concessions, that there's back homeowners dues, all these other things, keep in mind that's reducing the lender's net. And when the lender's net is reduced, that's when they start looking at fees and commissions to be cut. Investor guidelines can dictate commissions. Very few investors out there will limit it to 5%, but some do. The first and second with the same lender, sometimes if both are taking a loss, they will cap your commission. How many of you ever done a first and second with Wells together? Okay. Was it Wells home equity?
It was Wells and then Wells and that.
Okay. Generally, they will cap your commission at 4% if it's Wells home equity. They have 3 entities. They have Wells Financial, Wells Home Mortgage, Wells Home Equity. Generally, we see if it's Wells Home Equity, the second lien holder, not Wells first, but the second one, if they're shorted, will cap you at 4%. That's the only one I've ever seen done at 4%, by the way. But keep in mind, if both the first and second are shorted, and it's with the same company, they may reduce your commissions. If you're the same agent on both sides, they tend to cap the commission. Sometimes they'll only pay 3%, sometimes they pay 4 or 5%. But if you're representing both sides, they will sometimes cap the commission. If you're related to the seller, if you list your own home, obviously your commission is going to get cut. And some lenders have a cap on high dollar commissions. So they will say that the cap commission I pay is $50,000, which obviously you have to have a very big house to get that commission. But they will cap the commissions at a certain price point of $50,000, $60,000. It's very rare that we see that. So let's talk about counteroffers for a minute. Again, it's all because of the BPO. Counteroffers are based on the BPO, and you have limited negotiating power with the lender. In a traditional a traditional real estate transaction, counteroffers back and forth, it's kind of an emotional thing where like who has control. Where the seller says, I want $200,000, the buyer offers $170,000. The seller says, oh no, $190,000. The buyer says, oh no, $180,000. And it's kind of like who has control, and it's a very emotional thing. Okay, not so with the short sale. With the short sale, it's based on analytics. The bank has said, this is the BPO, this is my loss, this is the price I want. It's very hard to negotiate a counter. We do it all the time. But when a bank says, I want $200,000, and you've got a contract at $160,000, and you come back and say, oh, good news, the buyer just came up $5,000, we say, bad news, the buyer needs to come up more. It's not even worth submitting to the bank. They want you to get very, very close to their number on a counteroffer. Appeals are very difficult. We talked about that. We'll do the appeals. We'll collect the comps from you. We have the appraisal through Walker Jackson. We'll do it, but they are difficult. Just know that. And countering to a bank's counteroffer can elongate the process. We have seen banks, such as Wells, say, here's my offer price, come up to this price, okay? When the buyer counters to the bank's price, we also said to us, we're gonna put it back to review, give us 4 weeks. So it definitely can elongate the process if we're not coming up to the full counter. And you also have